Hi everyone, welcome to Stockseers. In our previous training video, we explained how to make money by trading within different types of channels. Now we will discuss how to use patterns within these channels or anywhere else, and in which situations money can be made. Who draws these chart patterns? It's drawn by an invisible hand. In this context, I also want to refer to Adam Smith's theory of the invisible hand. The market is formed by the randomness of emotions and behaviors of the actors in the market. This is what I mean by the invisible hand. Who are these actors? Governments, corporate managements, speculators, large investors, small investors, and various other market dynamics. The emotions of these actors, their appetites, fears, angers, and greeds, combine to move prices in the direction of supply or demand. Whichever emotional state dominates, the price moves in that direction. These price movements are recorded on the chart just like a seismograph records earthquakes. These movements create patterns on the charts that can be analyzed. Simply put, they give you a clue about where we are in the cycle of these actors' emotions. Why chart patterns? Actually, our main goal is to be able to see the accumulated energy. Whether it's support and resistance, indicators, or patterns, this is what we try to do. But they have differences. Support and resistance can provide good entry and exit points and enable trading within the trend. Indicators can say something about the strength of the trend, but patterns are quite successful in capturing energy in both directions. They are suitable for short and medium-term investments. Over time, combining these will give the best result. For example, a pattern forming as the price approaches a channel support makes it a much safer entry point for the stock. What are the types of patterns? Triangles, ascending, descending, symmetric. Flags, flag, pennant, rectangle. Cups, cup with handle, rounded bottom and rounded top. Head and shoulders and inverse head and shoulders. Tops or bottoms, double, triple bottoms, and double, triple tops and Adam Eve. Wedges, falling wedge and rising wedge. In literature, they are divided into trend reversal and trend continuation patterns, but I don't find this categorization correct. For example, the symmetric triangle doesn't belong to any category. It is a pattern of indecision. I will categorize the formations themselves because it will be more memorable this way. Ascending triangle. It is one of my favorite formations. The formation of a horizontal resistance accumulates good energy in the stock. This formation describes a triangle formed by a horizontal resistance line and a gradually increasing support line. As prices slowly rise, the resistance formed at horizontal tops creates a triangle. Ascending triangles generally indicate a continuation of an upward price trend. The target is the distance inside the triangle. I added a real example of an ascending triangle formation because I wanted you to see how the pattern you saw in the drawing actually looks in reality. After each formation description, I will show you how it looks with a real example. Descending triangle. It is the exact opposite of the ascending triangle. This time, a horizontal support is formed and this support wears out. A descending resistance comes and they form a triangle. In fact, the tired support and the prices forming descending tops to draw a descending resistance line indicate that the price will continue downwards and these triangles generally break down. The target is the same as the ascending triangle, going down the distance inside the triangle. Actually, it is a problematic pattern and they are not as stable as ascending triangles. It is a continuation pattern in a downtrend, but it is indecisive in an uptrend. It can go in both directions. Therefore, it is beneficial to follow which direction it breaks. Symmetric triangle. It is largely indecisive. A descending resistance from above and a rising support from below form a triangle, and it is symmetric. It is not very possible to determine the direction in this pattern alone. It can move in both directions, but after seeing which direction the triangle breaks, a position can be taken for that direction. The target is primarily the depth of the triangle. Flag formation. When entering a short-term consolidation period after a sharp price movement, the formation of dips and tops close to parallel creating a channel is called the flag formation. It draws a rectangle opposite to the direction of the trend. In this formation, the volume decreases and the stock rests. The sharp trend at the beginning of the flag formation is called the pole. It is a formation with a very high reliability. It can be seen in both downtrend and uptrend, and it is a pattern we assume the trend will continue. When the parallel rectangle breaks, the volume increases, and it is expected to rise as much as the flag's pole. Pennant formation. After a sharp price movement, when it enters a consolidation period, where the bottoms and tops narrow towards each other, it is called a pennant formation. It actually resembles a symmetrical triangle, but differs in that it is more stable and smaller. There is a sharp trend movement beforehand, which we call the pole, similar to the flag pattern. It is a trend continuation pattern and is seen in both down and up trends. Its target is the length of the pole. Rectangle formation. It is identical to the flag and pennant formations, creating a horizontal parallel channel. However, this formation has a two-stage target. Target price 1 is a price movement equal to the depth of the rectangle. Target price 2 is the same as the flag and pennant, equal to the length of the trend pole. It is a difficult formation. It can be easily confused with a double top or double bottom. Rounded bottom formation. Although they are generally regarded as trend reversal formations, they are not always so. A rounded bottom can be seen in both downtrends and uptrends, and it is a bullish formation. It is more accurate to know it this way. The saucer formation resembles a bowl shape. Imagine a wide U-shaped base. With incoming sales, a bottom point is formed in the market. During this time, the horizontal movement continues for a while as the sales decrease at the bottom level because the purchases are not strong enough. The trading volume gradually decreases during the horizontal movement. Then, an upward movement begins with low momentum. Profit-taking occurs at the rounded peak, creating horizontal resistance. I have mentioned before that horizontal resistances are always important because they accumulate a lot of energy. Eventually, this horizontal resistance is broken upwards, and an upward movement begins at the depth of the rounded. Where should you buy? It is difficult to recognize the rounded when it is horizontal at the bottom because it can transform into another formation. If you recognize it at the bottom, you can give it a try, but the real buying point is where the top of the saucer is broken. I give it a chance at the bottom when it is horizontal, thinking it might be a rounded one, of course, with the stop-loss line drawn at the very bottom of the rounded. Rounded top formation. You can imagine the rounded top formation as the exact opposite of the rounded bottom formation. Think of an inverted U shape with a broad top. It can be observed in both uptrends and downtrends, serving as a bearish formation. Prices eventually peak with diminishing volume. Volume will gradually weaken, and prices will trace a slight oval pattern horizontally downward. It's important to be cautious at this point. It is a largely reliable formation. Again, the target is a decline of the depth of the basin. Cup and handle formation. It is one of the most beautiful and reliable formations with a high frequency of occurrence. It can be seen in both trend directions. Most of the short videos I post are in the cup and handle formation. In fact, every cup and handle is a rising triangle and works on the same logic. It is very similar to the rounded bottom formation, only it makes a correction from the rounded resistance and resembles a handle. So, we liken it to a cup with a handle next to it. It still draws its energy from horizontal resistance and has a target equal to the depth of the cup. Head and shoulders. Head and shoulders is one of the trend reversal formations. It is used to detect a downward turn in an upward trend. In an increasing trend, price movements first create the left shoulder, then a larger movement forms the head, and the following movement creates the right shoulder, resulting in the appearance of left shoulder, head, and right shoulder. The shoulders can never be higher than the head area. The neckline can be completely horizontal or upward sloping, but it can never slope downward. Volume is also important here. The highest volume is at the left shoulder. Although the price is higher at the head, the volume is lower and it is lowest at the right shoulder. Thus, volume decreases from the left shoulder to the right shoulder. This is an important confirmation. The target of the formation is the distance between the neckline and the head. Let me give you a tip on this matter. If a head and shoulders formation has occurred and the formation does not decline but continues to make new shoulders, this is an indicator of a significant rise. Inverse head and shoulders. The inverse head and shoulders pattern is formed at the bottom and occurs in a symmetrically opposite manner to the standard head and shoulders formation. It is an effective formation for identifying a bottom. The shoulders can never be higher than the head section. The neckline can be completely horizontal or may slope downwards, but the neckline can never slope upwards. To enter a trade, a break of the neckline is awaited, and again the target is the height between the head and the neckline. Double triple bottoms. These are definitively reversal patterns. Imagine a W shape in your chart after a decline. This bottom may sometimes be triple, but double bottoms are more commonly seen. Double or triple bottoms occur when, after a declining trend, prices form a bottom, rally upwards, then return to the previous bottom level before moving upwards again. This type of formation usually happens after a prolonged decline. Volume is low at the first bottom and higher at the second. Positions are taken when the breakout resistance is breached with high volume and the target is the distance from the bottom to this resistance, projected upwards. Here's a tip to make it easier to recognize double bottoms on your chart. Add the RSI indicator to your chart. Check if, while your price bottoms are forming horizontal lows, the lows in the RSI are ascending. If the RSI is making higher lows, it confirms the price bottoms, indicating positive divergence. This is a good method for deciding to enter a position and understanding that the declining trend is about to reverse. Double triple tops. This is a reversal formation that can appear as either a double or triple top, though the double top is more common. Regardless of being double or triple, the rules are the same. Imagine an M shape at the peak of an ascending trend, two peaks that cannot surpass each other. Volume is high at the first peak and diminishes at the second, indicating a lack of confidence and can lead to a downturn. Similar to the head and shoulders pattern, a neckline is formed, and the target moves down the distance from the peak to the neckline. The RSI indicator can also be used for confirmation. While the price forms peaks that are nearly equal and cannot surpass each other, you will likely see declining peaks in the RSI indicator known as negative divergence. This can again be used for confirmation. Adam-Eve or inverse Adam-Eve. This formation is also one of my favorites. All the rules of the double bottoms and double tops formations apply here, and the target is the same as theirs. The reason for mentioning this formation is that not every bottom has to be in the shape of a V. Sometimes next to a sharp V bottom, there might be a more rounded bottom. It's like having the letters V and U side by side. The sharp one is Adam, and the rounded one is Eve. It can be Adam-Eve, as well as Eve-Adam. Descending wedge. Despite its downward movement, it is a bullish pattern, signaling an upcoming rise. It is known as a continuation pattern, but it is not. This is because it can appear in both downtrends and uptrends and signals a potential rise, making it quite reliable. It is commonly seen and effectively showcases accumulating energy. Imagine a narrowing band that slopes downward and is not parallel, forming a triangular shape. This band is the falling wedge. Its initial target is the depth of the wedge, but it can be followed by even larger increases. Here are a few tips regarding this. If you see a falling wedge in an uptrend, do not worry. If you see a falling wedge after a downtrend, the margin of the downtrend is important. If you see a falling wedge after a small decline, it is still bullish, but the target rise might not be very large. However, if you see a falling wedge after a prolonged downtrend, it could signal a significant rise. Ascending wedge. It is invariably a bearish pattern observed in both uptrends and downtrends, signaling a forthcoming decline. The severity of the drop varies with the trend, but it is advisable to stay away from going long in this formation. It is reliable and frequently encountered. Imagine a narrowing and rising triangular diagonal shape. That's the form it takes. The target is a decline to the depth of the wedge, but sometimes the drop can be much deeper. Here are some tips. In the case of an ascending wedge, there's a 90% likelihood that it will be followed by a decline. This decline may be horizontally downward, but a decline nonetheless. What you should consider here is the magnitude of the margin in the preceding uptrend to the ascending wedge. If you see an ascending wedge after a very sharp and prolonged rise, do not consider going long. A severe drop is likely to follow, and the decline may extend beyond the formation's target. How to use formations. The ideal scenario is to open a position when a pattern resistance is broken with high volume. The broken resistance now becomes your stop loss. If the price returns inside the formation, there's no point in holding on to the stock. If it breaks again, you can try again. The second ideal scenario for buying is when the price pulls back. What is a pullback? Sometimes, after breaking its resistance or support, the price makes a pullback to that point and then continues towards the target of the formation. This is a nice confirmation. It is a verified point for buying. Of course, a pullback is not always visible. It's not correct to wait for a pullback every time, but if you catch a formation at a pullback, you can certainly try to open a position. Maintain your stop-loss discipline for proper risk management. A stop-loss means two things for a pattern. Imagine a triangle, support rising from below and resistance falling from above. If you want to open a long position, then your stop-loss is if the triangle's support is broken. And if the triangle's resistance is broken upwards, but then falls below the resistance again, this is also a stop-loss condition. If you don't wait for the right entry point, the risk increases. Don't be impatient about this, and you must wait for the most accurate moment. Otherwise, it will lead to a forced and early stop loss. Advantages of formations. They are simple and easy to remember. As you see patterns, your eyes will automatically get used to catching these formations. Therefore, practice a lot. Look for these formations on any chart. Your visual memory will store these scenes. They work with straightforward logic. Their logic is the same for everyone. Their logic isn't different for you or for me. If there's a cup with a handle, it's the same for both you and me. Setting their targets also requires simple logic. The logic of measuring their targets is very similar to each other. They are easy to trade as long as you maintain your discipline. If you maintain your timing for buying and your stop-loss discipline and can set the right targets, trading them is easy. Because they are simple formations and the probability of correct formations succeeding is high. Disadvantages of formations. They are not always very easy to see. For this, you need to train your eyes well on them. The way to do this is to practice finding patterns on random charts after learning the patterns in this video. In fact, we will also prepare try-yourself videos. These will greatly benefit you in training your eyes. They may not always move as expected. Sometimes they can be wasted due to market noise. Even the most beautiful and orderly formations may not work. The second reason is that no matter how correctly you set the target, it may not reach that target for another reason. This reason could be another strong resistance or a Fibonacci resistance. It can block the path of the formation. The simplicity of formations comes at the cost of uncertainty. I mentioned they work with simple logic, but there's no guarantee they will always work. If such simple patterns were the goose that laid the golden eggs, then everyone would be rich. Therefore, don't be a trader who tries to make money using only formations because that won't be enough. Sometimes they lie. They set traps. For example, if the price breaks the pattern resistance upwards with rising volume and you buy in, but then it immediately turns back and causes you a stop loss. This is called a bull trap. A bear trap is when support is broken downwards and then turns upwards. These traps are seen more often in low-volume stocks. But here's something else I should say. Traps exist not only for patterns, but also for every instrument in technical analysis. Experience comes into play exactly in these traps. In conclusion, this video aimed at the simplest efficient formations. When interpreted correctly and acted upon with discipline, formations can increase the chance of predicting the market's tendency to move in a certain direction in advance. However, every investment decision requires different analyses. Therefore, it's important to evaluate formations in conjunction with other analysis tools. I recommend watching the other training and analysis videos on our channel.